So today we are going to start with part 2 of fiscal policy. Now this part is very important because this part discusses government budget. In the previous lecture I talked about fiscal policy, fiscal conservatism, fiscal consolidation, fiscal expansion. We talked about all these things. Now all these things happen through a document of the government, that is government budget. Basically government budget is government's fiscal policy statement. All right. Now, today's lecture is important because you will understand what is this budget making process, what is this budget all about, and you'll also understand some important terms related to the budget. What is revenue expenditure, what is capital expenditure, what is capital receipts, what is revenue receipts, debt creating receipts, what is a balanced budget. These are some important terms that are used in the budget document and you need to be aware of them. All right. So overall, the general things about fiscal policy you understand now. But let's get into the finer details of this fiscal policy and this fiscal policy's document called government budget. Okay, so let's start with government budget. All right. Now, in the previous lecture, I told you that fiscal policy is all about government's receipts, the money that government receives, and government spending, government's expenditure. And through this receipts and expenditure, government influences the economy. We talked about how fiscal policy influences the economy. By increasing the receipts, by increasing income tax rates, government might increase its receipts, but government reduces aggregate demand of the economy that harms the economy. By reducing income tax and increasing expenditure, government increases aggregate demand, but that also has a harm, a disadvantage, and that is inflation. We talked about all these things. So fiscal policy is nothing but government's receipts and expenditure. Therefore, if government budget is a fiscal policy document, government budget is also nothing but government's receipts and government's expenditure. Okay? Now, the thing is that government presents this fiscal policy document every year and presents it in front of both houses of parliament. Okay. Now, government does that because it's a constitutional duty of the government. Okay. Article 112 of our constitution states that government shall present its account of receipts and expenditure every year before both houses of the parliament. Okay. This is a constitutional duty. Government cannot get away with this. And because it's a constitutional duty, government does that. Government presents its account of receipts and expenditure in front of the parliament every year. Generally, the date is 1st of February. Okay. Now, the thing is that it is a constitutional duty, but constitution has mentioned some other things also with respect to the format of the budget. Okay. But before we discuss the format of the budget, let me tell you that the constitution does not use the word budget. Okay. Budget is the term used by all of us. The constitution uses the term annual financial statement. So in the constitution, article 112, it is written that annual financial statement shall be presented before both houses of the parliament every year. So constitution uses the term annual financial statement, but all of us use the term budget. You need to be aware of that. Okay. Now let's talk about the budget. Okay. Now it's not just that the constitution has mentioned that you have to present a budget. The constitution has given some details about the format of the budget. Okay. The constitution says that since budget is all about receipts and expenditure, you will present the budget in such a way that all these receipts and expenditures are divided into two parts: revenue account and capital account. Okay. So all the receipts and expenditures that are in revenue account shall be presented as such, and all the receipts and expenditures that are presented in capital account will be presented in that account, presented as such. Okay. Now the thing is that article 112, constitution's article 112 mentions that receipts and expenditure shall be separated into revenue account and other accounts. So the constitution says other accounts, but those other accounts are nothing but capital accounts. Okay. The constitution doesn't use the word capital, but it means capital only. Okay. So as per the directives of the constitution, the budget is presented every year and it is presented in this format. All receipts and expenditures are divided into two parts: revenue account and capital account. So there are some revenue receipts, revenue expenditure. There are some capital receipts and capital expenditure. Now, what is the difference between the two? The thing is, we'll get to that when I'll get to capital account. Okay. In just one or two lines, you'll understand the difference. And mind you, there are questions or MCQs asked in the exam with respect to this difference between revenue account and capital account. They might ask you that, is interest payments paid by the government revenue expenditure or capital expenditure, right? Such questions can be asked. So you need to know the difference between revenue receipts and capital receipts, revenue expenditure and capital expenditure. All right. But it's a very easy difference and you'll understand that quickly. But I'll get to that when we'll discuss capital account. For now, just know this, that revenue account is all about day-to-day receipts and expenditures of the government. And capital account is all about long-term receipts and expenditure of the government. Okay, just remember these two terms, day-to-day and long-term. Okay, but there is more to it and we'll get to that. Don't worry, have some patience. Okay, the thing is that receipts in both revenue account and capital account are also subdivided. Okay, revenue receipts are divided into tax and non-tax because government receives money through tax, and there are some non-tax revenues also accruing to the government or coming to the government, right? So those are bracketed or those are categorized under non-tax revenue receipts. Then there are some capital receipts also. Some of them are debt taken by the government, but some capital receipts are non-debt creating. We'll talk about them. Okay. So let's quickly shift to revenue account. So first we'll talk about revenue account, and when we'll talk about capital account, then I'll explain to you what is the difference between the two. Okay. So let's first talk about revenue account. Okay. So revenue account has receipts, revenue account has expenditure. Now all these receipts are divided into two parts. Okay. Tax receipts, non-tax receipts. All right. Now, what are tax receipts? So taxes are of two types. Remember this. There are some direct taxes. There are some indirect taxes. Okay. Now, what are direct taxes? Hear me out carefully. You will understand the difference. Look, there is this person A. Okay. He earns an income and the government levies income tax on him. Okay. So he has to pay that income tax. Now, in this case, the point of levy of tax, where the tax is collected from, and the burden of the tax are on the same person. So all those taxes which have same point of levy, that means government is collecting from that person on whom the burden is put of that tax, then those taxes are direct taxes. Okay. What are indirect taxes? And you'll understand now. Let's suppose you buy this pen from a shop. Okay. Now this pen, let's suppose you are this person A. Now this pen costs 10 rupees, but government has levied a GST of 1 rupee on it. Okay. So how much money would you pay to buy this pen? Well, you will pay cost of this pen, right? And then you will pay 1 rupee GST. So this person will receive 11 rupees. Now the government would go to this shopkeeper and collect this 1 rupee. Now in this case, what is happening? The government is levying this tax on the shopkeeper, but the final burden of this tax comes on this person A. Yes, the burden of this tax is on this person, but it is being collected from someone else. So government is in a way indirectly collecting this GST from you, right? Not directly, but indirectly. Now these are examples of indirect taxes. Okay, very simple difference. So what are the examples of direct taxes? Well, income tax, corporate income tax, those are those taxes that are levied on the profits of corporates. Okay, then there is this thing called capital gain tax. When you buy a property of 1 crore and you sell it for 2 crore, you get a gain that is known as capital gain of 1 crore profit, right? Now government levies a tax on it. That is also a direct tax. What are the examples of indirect taxes? Well, GST is an example. Excise duty on liquor and petrol is an example. Custom duty, which is levied on imports of goods, that is an example of indirect tax. Okay, so government collects tax revenue in the form of direct taxes and indirect taxes. Very simple. Just remember this one difference. If the point of levy of tax and the burden of that tax fall on the same person, then that tax is direct. If it is on different people, different entities, then that is an indirect tax. Simple, right? So direct taxes, indirect taxes. Mind you, direct taxes are a little better than indirect taxes. It is said that if your revenues come more from direct taxes, then your taxation system is a little bit progressive. Okay? And if your revenues come more from indirect taxes, then your taxation system is a little bit regressive. So, a good economy or an economy that works for the welfare of the people, well, collects more progressive tax. Direct taxes are also known as progressive taxes and indirect taxes regressive. Okay. So, generally, it is argued that collect more money from direct taxes rather than indirect taxes. Now, what do you mean by progressive? What do you mean by regressive? Why are they called progressive? Why are they called regressive? We'll talk about that later. As of now, just know this, that it is good for a country to get more revenues from direct taxes than indirect taxes. Okay, because indirect taxes are progressive, direct taxes are progressive and indirect are regressive. So it is good to get more money from direct taxes. Okay, for now, just hold on to this fact. Okay, I'll explain what do you mean by the terms progressive and regressive later. Okay. Then there is some form of revenue collected by the government which is classified as non-tax revenue. Okay, so what are the examples? Let's suppose central government has given a loan to a state government. Okay, now this loan is for a period of 10 years, but every year state government pays interest on this loan. And after 10 years, it will return the entire loan amount back. Yes? So these interest payments received by the government are classified as non-tax revenue. Simple, because it is not a form of tax. Then there are various government companies. Air India at one point of time used to be a government company. ONGC is a government company. GAIL, SAIL, there are many government companies. Okay, and they earn some profit. So that is also a form of non-tax revenue, dividends and profits. Now, government also provides you some services, right? And charges a fee on it. So, for example, whenever you fill an examination form, anywhere, any competitive examination form, you pay a fee. You are paying an examination fee because government is providing you examination service for that competitive exam. So, you pay a fee for it. Okay. Now, those fees are non-tax revenue. Similarly, if you do something wrong, you are fined. You have to pay a fine. That fine is also non-tax revenue. Clear? Then sometimes central government of India receives grants from international organizations like UNESCO, UNICEF, right? These are categorized as non-tax revenue, external grants. Okay? These are categorized as what? Non-tax revenue. Okay? External grants. Please know the difference between external grants and loans. Government also receives loans from World Bank, IMF, right? Those are loans. What I'm talking about over here is UNESCO, UNICEF are grants. Difference between loans and grants is grants, you don't have to pay back grants, but you have to pay back loans, right? So grants, international grants given to central government are part of non-tax revenue. Clear? Very simple. Okay. Now, let's move forward. Okay, and talk about this expenditure part. Okay. So on the revenue account, government receives money, but government has to spend some money, right? So let's talk about expenditure. So what all is there in the revenue expenditure? Look, I said that if central government gives a loan to state government, when it receives interest payments on it, those are part of revenue receipts, non-tax receipts. right? But what if central government has taken a loan from World Bank and central government has to pay back interest payments? That is the money going away from central government that would come under expenditure, right? The interest received by the government is non-tax receipts, but the interest that the central government is paying is expenditure. Okay, revenue expenditure, mind you. So in revenue expenditure, there is payments of interest on loans taken. Clear? This is a very significant chunk of revenue expenditure, by the way. All right. Then salaries and pensions to the government employees, that is also revenue expenditure. Then government also provides some subsidies, that is also revenue expenditure. Then grants given to state government. Sometimes central government does not give a loan to state government. Sometimes central government gives a grant. Okay, remember, loan given to state government won't be in revenue expenditure. But grants, because grants are one-time payments, you don't have to get them back. Okay, so sometimes central government gives grants to state governments to build roads or whatnot, to hospitals and whatnot. Okay, COVID grants. These are central government is not expecting them back. Sometimes central government gives grants to developing countries like Bangladesh, Nepal, Bhutan, and all that. Right? All of this, all these grants. Remember, grants, not loans, are part of revenue expenditure. Okay, and sometimes government spends on sometimes or what all the time government spends on defense also. So expenditure on defense, for example, ration, subsidies, salaries of defense employees, all these things, all this expenditure on defense is part of revenue expenditure. All right, and many more like that. Clear? Very simple. So this is revenue expenditure. All right. Now always remember that if in revenue account expenditure is more than receipts, we say that the government is running revenue deficit, because this deficit is in revenue account. Okay, and if receipts are more than expenditure, we use the term surplus, revenue surplus. Okay, so if expenditure are more than receipts, revenue deficit. If receipts are more than expenditure, revenue surplus. Generally, almost every time, expenditure is more than receipts. That is why government runs a permanent revenue deficit. We run a revenue deficit. That is deficit in the revenue account. What is revenue deficit? Basically the difference between expenditure and receipts. So if your revenue expenditure is 200 and your revenue receipts are 160, then the revenue deficit would come to 40 rupees. Simple. All right. Now let's talk about capital account. Very important. Okay, capital account. And now I'll tell you what's the difference between revenue receipts and expenditure and capital receipts and expenditure. Okay, if through any receipt or expenditure there is a change in your asset or liability, then that is not a revenue receipt or revenue expenditure. That is a capital receipt and capital expenditure. So all transactions of the government that either increase or decrease assets of the government or increase or decrease liability of the government would become a part of capital account. So capital account are all those transactions, contains all those transactions that change a government's assets or liabilities. Okay, very simple. I'll explain with an example. First, let's talk about capital receipts. So what are capital receipts? Always remember this. If there is no change in asset or liability, it must be a revenue transaction, not a capital transaction. Just remember this. So in capital receipts, okay, if you are receiving money by reducing your assets or by increasing your liability, clear? Then that is capital receipts. Okay. If you are receiving money and either your assets are reduced or your liabilities have increased. For example, you have sold Air India company. Now that Air India company has been sold to Tata, you have received some money, but your asset has declined because Air India was your asset. Now it is no more. So your assets have declined, but you have received some money in exchange for that. That receipt would be capital receipt because your assets have changed. Similarly, if you receive loan from World Bank, not interest payments, loan, interest payments and loan, the entire loan amount are different. Okay, if you receive loan from World Bank, then that increases your liability because you have to pay back that loan. That is capital receipt. Okay, so if your assets have declined or your liabilities have increased, then you have received capital receipts. If your assets have increased or your liabilities have yet declined, then it is a capital expenditure. And let us discuss some examples about capital receipts. Okay, what did I tell you? If your assets decline or your liabilities increase, those are capital receipts. Now, capital receipts are of two types. Either they increase debt on you or they do not increase debt on you. Okay, now loans raised by government. So when government sells government securities are nothing but borrowing instruments of the government, right? Government borrows money through those government securities. So when government borrows money, government receives money. That is receipt. But that increases the liability of the government because that loan has to be paid back. So capital receipt. Okay. Then sometimes you deposit money in Provident Fund or any other small saving schemes like Kisan Vikas Patra, Provident Fund Scheme, National Saving Certificate Scheme. Now you put money in these schemes because you earn an interest on them. And after 20, 30 years, you receive the lump sum amount along with the interest, right? So in a sense, you're giving money to the government and government is paying you interest on it, right? This is what Provident Fund Scheme is. So all the money raised through small saving schemes. Now, these increase government's liability because these increase government's debt, right? So loans received by the government, money received in these small saving schemes increase the debt of the government. That is why they are called debt creating receipts. And because they are increasing liability, they are called capital receipts. But some capital receipts are non-debt. Okay. Now listen to me carefully. Let's suppose World Bank gave a loan to Government of India. And the period of that loan was 10 years. Every year, government pays some interest on it. Now, that interest payment is revenue expenditure. Interest payment is revenue expenditure. Okay. But after 10 years, when the government pays the entire amount back, that is capital expenditure. Why? Why? Because the thing is that is capital expenditure. Yes, I jumped onto expenditure. We are talking about receipts. I'm sorry. Let's reverse the example in this case. Okay? Hear me out carefully. I'm so sorry. I jumped to capital expenditure. Let's suppose Government of India, central government, has given a loan to state government. Okay? Now, every year, this that loan was given for 10 years. Same example as World Bank. And every year, the state government was paying back some interest. Okay. Now, that interest payment that the Government of India received is part of revenue receipts. Interest payment is revenue receipts. But after 10 years, when the state government returns the entire loan amount, that would be capital receipts. And why are we calling it capital receipts? Okay, we are calling it capital receipts because you remember in cases of banks, when banks give out loan, those loans are assets of banks. Similarly, when central government gave out this loan to state government, it was an asset for the central government. But once state government has paid back that entire loan amount, now it is no longer an asset. So assets have reduced, right? But you're receiving money because of it. So it is capital receipts. Okay? Because your assets are reduced, but you have received money, capital receipts. But this receipt is not creating any debt on you. So it is a non-debt capital receipt. Very simple. Okay? Clear? So recovery of loans given by central government. Yes? Now, disinvestment proceeds. The other non-debt creating capital receipt is disinvestment. What is disinvestment? When government sells its assets. So government had Air India. When government sold Air India, its assets got reduced, but it received money, non-debt creating capital receipt. Clear? Now, tomorrow government decides that I will sell 30% shares of ONGC company. 30% share. Now, when this 30% share would be sold, government would get money in return. That would be receipts. But that receipt has reduced government's asset by 30%. Right? So, non-debt creating capital receipt. But this is an example of disinvestment. So 30% sale of ONGC, 100% sale of Air India, 10% share of Indian Bank or Punjab National Bank. All of this is categorized as disinvestment and it is a non-debt creating capital receipt. Clear? Very simple. All right. Now let's talk about capital expenditure. Very important. Hear me out carefully. I told you capital expenditure is that expenditure which either increases your assets or reduces your liability. Remember, any change in asset or liability is capital account transaction. So capital expenditure is the one in which either your assets are increased or your liability gets reduced. Okay. Now, the thing is that let's suppose central government has given a loan to state government. Now that loan that is given by central government is basically an expenditure of the government. Government is giving money out. But that loan is creating an asset because all loans are assets. So the asset of central government are increasing. Yes, capital expenditure. Loans given by central government. Okay. Now we'll come to that World Bank example. Okay. Let's suppose central government received few years back a loan from World Bank. Time period was 10 years. Every year the government was paying back interest. That interest is revenue expenditure. Okay. But when the government decides to pay back the entire loan amount after 10 years, that expenditure is capital expenditure. Why? Because when there was this loan, government had this liability. Now, after paying back this loan, government's liability is reduced. Right? Liability is reduced, capital expenditure. So, entire loan amount paid back by the central government, capital expenditure. All right. Then another example. Let's suppose government spends money to build infrastructure. Roads, bridges, electricity infrastructure, water infrastructure, urban infrastructure. Government is spending money to build this infrastructure. Now, this infrastructure is nothing but an asset of the government. Those roads are assets of the government. Let's suppose government spent money to create UPI. UPI is a digital asset of the government, right? Let's suppose government spent money to build national highway. That is an asset of the government, infrastructure asset of the government. Now the money spent on that is expenditure naturally, but that has increased your assets. So it is capital expenditure. Expenditure on infrastructure or assets like roads, bridges, ports or digital assets. Capital expenditure. Okay. Then we talked about defense expenditure. You remember that? Right? Now, defense expenditure by the government is also of two types: revenue, capital. So, when government is paying salaries of armed forces personnel, government is buying them goods and services, ration, all these things. That is revenue defense expenditure. But when government is buying a fighter jet, a tank, a submarine, a aircraft carrier, those are assets of the government. So that would be defense capital expenditure. So defense expenditure can come in both revenue and capital account. Depends on the type of expenditure. If you are buying defense related assets, defense capital expenditure. If you're just spending money on armed forces personnel, salaries, pensions, their provisioning for their food and supplies, all of that, revenue defense expenditure. So capital expenditure on defense like fighter jets, tanks, submarines, all are part of capital expenditure. Okay, this is the difference. Clear? So now I hope you know what is the difference between revenue receipts and capital receipts, revenue expenditure and capital expenditure. Anything that changes assets or liabilities of the government are taken into capital account. For receipts, either the assets have to decline or liabilities have to increase. For expenditure, either the assets have to increase or liabilities have to decline. All right, make sense? Now, let me tell you one thing right at the outset before we jump on to the next topic. Okay, there is this question asked by many economists. Okay, and it is a very pertinent question. Okay, government will incur expenditure. That is the job of the government. Government will have expenditure. It cannot only have receipts. It will have expenditure. And these expenditures are of two types: revenue expenditure, capital expenditure. The question is, which expenditure is better? Revenue expenditure is better or capital expenditure is better? Now, the answer to this question is, think about it though. The answer to this question is that revenue expenditure is from an economist's perspective. Okay? Not from other perspectives, from the point of view of an economist, which is who is concerned about the growth of the country. Okay? For them, revenue expenditure is wasteful expenditure. It is a waste of money. Clear? Yes, government has to spend money on law and order. Government has to pay back interest on loans taken. Government has to give subsidies. Yes, but still, it is wasteful expenditure. Whereas capital expenditure is not at all wasteful. It is a good form of expenditure, and every government should strive towards reducing its revenue expenditure and increasing its capital expenditure. Why? Because capital expenditure increases your assets. You build roads, bridges, all these assets, and these assets improve the production capacity of your economy. Right? Remember that example of one machine. If one machine produces 100 pens, and if you have two machines, your capacity to produce 200 pens would be there. So your GDP's capacity has increased from 100 pens to 200 pens. And that machine was a capital good. And that is why spending on capital goods is better, because it improves your production capacity. Similarly, if government spends money in the capital account, capital expenditure is better because it increases your assets, which improve your production capacity. Your GDP's potential increases to produce more and more. Right? If you have more electricity infrastructure, more factories would run. More factories would run because factories run on electricity. More factories would run, more goods would be produced. So your GDP would get increased. So capital expenditure is better and revenue expenditure is bad. Right? That is why it is argued that government should minimize its revenue expenditure and maximize its capital expenditure, because capital expenditure is gainful. And this rule is known as the golden rule of public finance. What is the golden rule of public finance? Minimize your revenue expenditure and maximize your capital expenditure. Okay, the official definition goes like this: not to finance your day-to-day expenditure, which is revenue expenditure. Remember, day-to-day. Not to finance your day-to-day expenditure from receipts. Okay, this is the golden rule. If you are taking any, so basically golden rule is minimize your revenue expenditure, maximize your capital expenditure. Clear? Remember this fact.